Financial markets and products. Financial markets and products in FRM Part 1 provides a comprehensive understanding of financial institutions, trading markets, and the instruments used to transfer, hedge, and manage financial risk. The curriculum examines how banks, insurance companies, pension funds, mutual funds, hedge funds, and other intermediaries operate within the global financial system. Candidates study the structure and mechanics of exchange-traded and over-the-counter markets, emphasizing liquidity, transparency, settlement, and counterparty risk considerations. The topic also introduces the core characteristics and valuation principles of derivatives, including forwards, futures, swaps, and options. Students learn how these instruments are used for hedging, speculation, and arbitrage across asset classes. By integrating market structure, institutional behavior, and financial product analysis, the curriculum builds a practical understanding of how risks are created, transferred, and managed throughout interconnected financial markets. Financial institutions and intermediation. A central component of the topic focuses on the role of financial institutions in supporting economic activity and managing financial risk. Candidates analyze the business models and risk exposures of commercial banks, investment banks, insurance companies, pension funds, and asset managers. The curriculum explains economic capital, regulatory capital, Basel capital requirements, and the moral hazard problems associated with deposit insurance and leverage. Insurance products and pension structures are studied to understand mortality risk, longevity risk, underwriting risk, and liability management. Students also examine hedge fund strategies, mutual fund structures, exchange-traded funds, and performance measurement issues. Particular attention is given to conflicts of interest, governance challenges, and incentive structures that can influence institutional behavior. Understanding financial intermediaries is essential because these institutions serve as the primary channels through which credit, liquidity, investment capital, and risk management services flow throughout the financial system. Derivatives and risk transfer mechanisms. The curriculum places strong emphasis on derivatives because these instruments are fundamental tools for transferring and managing financial risk. Candidates study forwards, futures, options, and swaps, learning how their payoffs, pricing relationships, and trading mechanics differ across markets. Exchange-traded derivatives are compared with over-the-counter contracts in terms of flexibility, liquidity, transparency, and counterparty risk exposure. Students calculate payoffs from hedging, speculative, and arbitrage strategies while examining how derivatives can reduce or amplify risk depending on their use. The curriculum also explains margining systems, collateralization, central counterparties, netting arrangements, and clearing mechanisms designed to reduce systemic risk. More advanced topics include exotic options, structured products, volatility swaps, and credit default swaps. These concepts demonstrate how derivative markets enable financial institutions to manage interest rate risk, currency risk, commodity price risk, equity exposure, and credit risk in increasingly complex global markets. Interest rates, fixed income, and currency markets. Financial markets and products also explores interest rate markets, bond valuation, and foreign exchange markets because these areas are central to global finance and risk management. Candidates study treasury securities, repo markets, SOFR, bond pricing, yield curves, duration, convexity, and forward interest rates. The curriculum explains how changes in interest rates influence bond values and portfolio risk exposures, while futures and swaps are used to hedge interest rate sensitivity. In foreign exchange markets, students analyze spot rates, forward rates, currency swaps, and interest rate parity relationships. Transaction, translation, and economic currency risks are examined alongside hedging strategies using derivatives and multi-currency portfolios. Corporate bonds and high-yield securities are studied to understand default risk, spread risk, and expected return components. These topics help candidates understand how fixed income and currency markets influence funding costs, investment performance, and financial stability within international financial systems. Mortgage-backed securities and structured products. The curriculum introduces mortgage-backed securities and structured finance products to demonstrate how financial engineering can redistribute credit and prepayment risk across investors. Candidates study residential mortgage structures, mortgage payment calculations, mortgage pools, and the securitization process used to create pass-through securities and collateralized mortgage obligations. The topic explains weighted average coupon calculations, conditional prepayment rates, and prepayment modeling assumptions that influence mortgage-backed security valuation. Students also examine interest-only securities, principal-only securities, and dollar roll transactions commonly used in mortgage markets. Monte Carlo simulation and option-adjusted spread analysis are introduced as valuation tools for complex structured products. The curriculum emphasizes how securitization improves liquidity and risk distribution while also creating model risk, complexity, and systemic vulnerabilities. These lessons are particularly important given the role mortgage-backed securities and structured credit products played during the global financial crisis. Applications in financial risk management. The overall objective of financial markets and products is to provide candidates with practical knowledge of financial instruments and market mechanisms that support professional risk management activities. Understanding how products are priced, traded, hedged, and regulated allows risk managers to identify vulnerabilities and evaluate risk exposures across portfolios and institutions. The curriculum integrates derivative pricing, bond valuation, market structure analysis, and institutional behavior into a unified framework for analyzing financial risk. Candidates learn how hedging strategies can reduce market uncertainty, how leverage and liquidity influence financial stability, and how interconnected markets transmit risk globally.